Hi, this is Smriti Rakheja. I am delivering the report on Google Incorporation as a part of Equity Research Initiative Spring Chapter 2013. My company name is Google Incorporation. It belongs to the sector technology and is a major player in the industry of Internet information providers. It ranked 73 in Fortune 50 and 500 in Standard & Poor. The following report is based on three categories: fundamental analysis, ratio analysis, and equity valuation using free cash flow to equity method. On performing a SWOT analysis on Google Incorporation, its internal factor strength is observed in its high brand value and product differentiation. Google controls 83.7% of the global desktop search market, 89% of the global mobile search market, has 45.72 billion in cash and only 3 billion in long-term debt. Also, its vast application ecosystem and tons of apps and developers adds to its strength. Weaknesses: Google is dependent on Microsoft's operating system on desktops for its desktop search engine, yet it competes with Microsoft in numerous different sectors. It also missed earnings expectations last quarter and saw its stock price fall. Google is losing map services market share as Apple continues to box out Google in its very lucrative industry. After looking at the internal factors, now we have a look at the external factors affecting Google's performance. Total paid clicks continue to rise. Google is making a lot of headway into the tablet market. The smartphone market in the US isn't saturated yet, and millions still need smartphones, many of which will come with Android operating system. Location-based revenue is expected to grow from 2.8 billion in 2010 to 10.3 billion in 2012. Threats from competitors lie amongst the biggest threats for Google. Porter's 5 forces model. Threat of competitors: brand identity is high, switching cost is zero, product differentiation is high, so rivalry from the competitors is moderate. Exit barriers is low as there are no rules ethics which have been defined so far in this environment. Currently there are only few rivals, so degree of rivalry is more oriented to an oligarchy. This could bring attention of UN or individual countries as a restriction of trade in the future. Moving forward to the buyer power, buyer size and volume is small, change cost frequency is very low, product service importance is very high, therefore the threat of backward integration is high. High supplier power, threat of forward integration is low, switching cost is low, so importance of volumes to the supplier is high. Entry barriers due to brand identity are there, scales are high, switching cost is low, legislative interference is high, threat of substitutes is high. Following is a comparison chart of Google and its two competitors. Now we move forward to the financials of Google. Higher the EBITDA margin, the lesser is the cost of goods sold, so better is the company's position. Comparatively, Google is in a bad position. As we can see, net profit to net sales ratio, it's higher than its peers and it's higher than its industry average also. So Google is in a good position with respect to that. Very high ROE of Google analysis along with leverage ratios indicate excessive leverage is taken on by Google. It is also seen that FB has the highest liquidity. Moving forward to the debt to shareholders equity, this indicates that Google is not at all an over leveraged to a huge extent. Moving forward to the share price to the EPS ratio, this indicates that Google has reached a high stage. On the other hand, Yahoo in comparison still has some growth potential. Google is going in terms of price to equity. High value of share price to net sales indicates that Google has a great demand in stock market. There are some of the current financials of Google increasing graph of the earnings per share shown in the next slide. This graph shows that there is greater growth in the stock market for the company. Moving forward to the valuation. When beta is less than 1, the returns of stocks are no more or less volatile than returns of the market and vice versa. As seen, stock returns are more volatile than the market returns. Dividend model is not valid for the company as the company doesn't give dividends. Using the FCFE model, intrinsic value of the stock is less than the market price, hence a sell is recommended. Hence a sell is recommended in Google Incorporation.